Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone. Welcome to MacroEdge Radio. This is John Galt speaking. We're going to crank the show up here in just a few minutes as our guest will join us. Let me hit a quick market review so we don't interrupt his time. First and foremost, the Dow's up 238 to 46,190 to finish the week. S&P up 35 to 66.64. NASDAQ up 117 to 22,675. They went for the VIX suppression route, took it down from 28 this morning to 20.76. Relatively light volume with periods of sunshine and distribution throughout the day. Gold finally got hit. And I would take every corrective action in gold as an opportunity. We'll talk about that with our guest here shortly. Robert Rios, the Peruvian Bull. It was down 91.30 to 42.13 after being up over almost to 4,400 earlier today. Silver down $3.19 to $50.10. Guys, gals, it had to happen. It was going to break. It was due to break. Thankfully, it broke, but it held the $50 level. The real support is around 48, but if it can hold 50 through the weekend and next week, God help everyone who's a bear on that market. WTI up 8 cents to 57.34, a big indication of economic activity coming to a crawl, along with Brit up 32 cents to 61.38 to close the week out. 2-year up 35 ticks to 3.412. Can't even read my own handwriting. Excuse me. 10-year up 38 ticks to 4.013. It got back above the 4% level. Everyone's hyperventilating. The bigger news, that's 3.442%. I'm sorry. The big news is that the 2-year did not get back above 3.5%. Worth watching along with the SOFR, which is behaving uncomfortably weird. The key on the markets this week was recorrelation of the U.S. dollar and the Japanese yen at 150.63. Now, for those of you who think my voice sounds weird, I apologize. It is the flu and cold edition this week as I'm getting over my summertime cold. If you're not aware of the seasons in Florida, we go from summer to hurricane season to summer number 2, which is what we're finishing up now. Then we have light summer. Then we have autumn, which is actually just December and January. Then we have spring, which is February. Then we're back into another light summer, and then it just gets hot as hell for 6 months. That is your seasons in Florida. If you're not used to that, don't move down here. We have gators. We have wild monkeys, as some of the videos now are circulating of Silver Springs up by Ocala. We have crocodiles. We have poisonous snakes, poisonous spiders, and lots of crypto billionaires in Miami doing speeches off of balconies talking about how this is the ultimate buying opportunity after it crashed and burned this week. Don't ask me to explain it. I'm just telling you what I've seen on the internet. And the internet has become a very bizarre place. The big picture from what we saw today was a taco. We got down towards the 50-day moving average on the S&P 500, and President Taco Bell broke out, unleashed, and brought the taco into full-blown fruit. I mean, just blew it wide open. Well, China's not that bad. Xi's a wonderful guy. We can't keep these tariffs at these levels forever. It was a heaping serving of Taco Bell value meals from early this morning until tonight. And thankfully, we don't have to talk about that anymore. We'll talk more macro a little bit later. But right now, I'm honored to bring Robert Rios, the Peruvian Bull, onto the program. Robert, welcome to MacroEdge Radio.
Hey, thanks for having me, guys.
Well, let's get into it here. First, we're going to advertise your Substack. Bring it on out to everybody. Talk about your so people who are not familiar with you on X, because we do have some people, I can't believe that, who don't know who you are. Let them know where to find you and get a hold of you on social media as well as Substack first.
Yeah, sure. Obviously I'm here on Twitter at Peruvian_Bull. On Substack, I write the Dollar Endgame Substack covering macro mainly just I would say like general macro, but more of the focus on Japan, metals, and monetary plumbing, and U.S. obviously. But yeah, you can find me on either of those. I also have a YouTube channel if you want to subscribe there and watch some of my podcasts.
Fantastic. Well, let's get your take first of what happened this week with gold and silver, platinum, and palladium. And then we're going to go into the who, what, when, where, and why. And believe it or not, yes, yours truly, who loves to talk gold and silver, will talk about the miners with you all night long, except our audience will probably be suicidal if we do that, especially if they think you can go long juniors into these kind of markets. What did you make of that market action this week? It was crazy.
Oh, it's absolutely insane. And it's funny you talk about miners because I actually used to be huge into buying mining stocks. I actually put a lot of my net worth into them in 2020. But my mistake was doing basically like leaps plays on them in 2020 and 2021 when the timing was clearly wrong. So I lost a lot of money on that trade. But I think everyone who's in the room who's a precious metals investor knows that buying the miners is completely different from buying the actual metal. And if you don't believe that that's true, then just look at this week. We've had multiple days where miners have sold off and gold has gone up, or even the inverse, right? So, yeah, no, it's been a crazy, crazy week for gold. Obviously, we broke the 42 handle. Um, and then obviously got it even up into the 4300s. We had a print of like 110, 110, 120 on I think it was Wednesday. And then today, obviously, we had a huge like whipsaw where we went up and down another $115. So huge volatility in the market, and everyone has been claiming right that gold cannot keep climbing higher. That's what I've seen all of the last like 6 7 weeks we've started this ascent. Ever since really like late August when we first broke out of that channel. And again, I think the problem is that these people don't understand the fundamental drivers for gold, right? Obviously, you have central bank buying coming in, which is pretty massive. The last 3 years, there's been over 1,000 tons annually purchased globally by central banks. August was also a strong month. We saw Poland buying like 5 tons. China kept buying. Um, India's been buying gold consistently. Brazil, even countries that we would say are not necessarily like antithetical to the West or to the United States are still buying gold. And there's also obviously rotation in the professional investor space, right? You look at all the bullion banks and even just some of the asset managers. JP Morgan raised their price target from obviously 4,300 after it smashed that level to 4,900. Jamie Dimon was on I think was it MSN Squawk Box or whatever, saying that we might be seeing $5,000 to $10,000 gold prices. And it's pretty interesting, right? Because these are the people who historically, if you follow the gold space, like all the bullion banks were basically not putting out anything bullish on any of the metals, right? They were always pretty neutral. I mean, you sometimes get a couple analysts here and there, but overall the entire space was pretty dead in terms of its overall sentiment towards the precious metals. And now we see a complete flip. And I think it's because, high net worth investors, macro discretionary funds, right? These people are getting into gold in size, um, likely because of just a confluence of macro factors. Obviously, we still have the deficit problem, 7% deficit to GDP, while the Fed is still at pretty elevated rates and they're promising to lower, more quickly, especially into next year. There's several Fed governors who've hinted that they think the neutral rate is somewhere below 1%, 0.75% or even lower. And so if that's going to be, the end state or the terminal rate for the Fed, then that means that we have a lot of cutting to do. And that environment, compared with the weak dollar that we've seen so far this year, right? The dollar index is still down like, last I checked, 9 or 10% for the year. Those are just massive headwinds for gold. So it just makes sense to be buying gold at these levels, even though we are maybe overbought, temporarily on a weekly basis. I would say overall, like the macro trends are pretty strong tailwinds for gold.
I 110% agree. And I think right now, to be honest, I'll be upfront with you. I don't know if you've read my stuff, but I predicted in December a 36 to 3,800 range top for the market this year. But that was before I realized that we had President Insanity coming into office. I never predicted he would carry a trade war to the extent that he has. And I believe that the impacts of the trade war still haven't been fully measured in the economy, which is part of the reason people are hedging with precious metals. At this point in time, it doesn't make any sense to use the dollar as a hedge when the administration has come in and blatantly stated we want to devalue the dollar to improve our trading status.
Yeah, exactly. The weak dollar premise, right? That's been championed by Besant. Yeah, and then again, that people don't realize like the reason why they need a weak dollar is because in general, right, the global monetary system functions on dollars, and so a strong dollar, like Brent Johnson mentioned, is actually bad for global liquidity. So a weak dollar solves that, but more importantly, obviously, a weak dollar can assuage some of their trade concerns, right? So they can, even though that imports get more expensive, we can more easily create trade deals with countries when we're artificially suppressing the value of the dollar. And when we get into these trade spats, like we just did with China and Argentina, we open up a dollar swap line, right, of $20 billion so that we can get access to at least what some people are claiming is Argentina's rare earth minerals, right? Their lithium mines. And so it allows us kind of some leeway. Whereas if we were, pushing a strong dollar policy, printing $20 billion on a whim would be, yeah, pretty antithetical to that. So, yeah, I think it's just it's a confluence of things. Like, there's no single like you can point at this and this is exactly why gold is rising. I think it's just a confluence of all these different factors. But overall, like we're going into the fourth quarter here with 7% deficit to GDP, $37 trillion of debt. The Fed's going to cut, and we're not even fighting a major war, like at least directly, right? And we're not fighting a recession. So what the hell is going on? Like this doesn't really happen in U.S. economic history, right? So that tells you that if we do confront a crisis in Q1 or Q2 of next year, the deficits are going to blow out even more. The Fed's going to print even more, and all these hard assets are going to just go to the moon.
Well, I think we're already in the financial crisis. It's similar to the 2007 scenario, not identical, folks. I'm not saying we're going through another real estate crisis. We will have a real estate crisis, but I think that the financial crisis has arrived. It's just not being measured or recognized by anyone with any level of common sense. And precious metals are a very good proxy for how the world feels the economy is actually behaving and how our economy is actually behaving. And it's not giving a very, shall we say, positive vote forward for how the economic activity is going to move ahead in this world or in our country.
Yeah, no, absolutely not. And again, it's important to remember, right? Like I tweeted this out the other day that got a lot of engagement, like 2,000 likes. I said, if you just inflation, the 1980 peak for silver for inflation, the actual price of silver, the actual peak is like $208. And so by those terms, we're nowhere close to where the real all-time high for silver is, and same with gold. Although we're sitting here at 4,000, right? Like what, 200 or something, the inflation adjusted peak that we barely just passed, like 4 or 5 months ago, was still like 3,500 after you adjust for all the monetary easing since 2021. And so if we are going to expect more inflation coming forward, we should expect gold to continue to climb. And we're still, by the way, underallocated. So you look at the average portfolio in the West, you know, what like American retail investor, high net worth, even like a family office, 2 to 3% of that is invested in gold, if that, right? Um, Whereas historically the ratio was more like 10%, right, between 5 and 10%. And you have major asset managers like J.P. Morgan coming out and saying, hey, like we should actually be doing 10, 15, maybe even 20%. I believe there's a report by Morgan Stanley earlier this week saying that the 60/40 is dead. And instead of the 60/40, it should be 60/20/20, and one of the 20% should be gold. And so when we have this, like, I guess you could say, like, allocation shift in portfolios and everyone's under allocated, it just tells you that we have a lot higher to go in the long run, right? I'm not saying that next week we're going to be going to 5,000. That's not what I'm saying. Just the structural factors here are very strong, and you've got to remember, right? We're entering this kind of weak dollar policy. You guys could call it Treasury QE with the Treasury buybacks. and the shifted duration to the short end. So that adds more liquidity to the system without a Fed easing cycle ostensibly. And so that means that, again, there's just more liquidity, more dollars going to be printed, and gold is just going to go higher.
Well, Fidel Cashflow would like to ask a question. Fidel, bring it on, sir, real quick before we get back into the discussion and we start talking silver.
Hey everybody. Thanks for having me on here to be able to ask questions. I'm really enjoying everything MacroEdge. Yourself, John Galt, PB, Six Finance, and Don has been putting out. PB, this is AWS. You probably know me. It's been a while.
Yeah, what's up, man? It has been a while.
Yeah. So I was actually kind of trying to research the BOJ's new repo operation framework that they're putting out. That are amendments to its general repo and collateral framework. So it's updating prices of eligible collateral and margin ratios for the purchase and sale of Japanese government bonds. So they're basically raising the bar for what qualifies as collateral and how much margin is needed when banks or dealer banks borrow against JGBs and repo transactions. The DTCC actually did the same thing where they actually made MBS collateral. I think it was 2022. They put out a DTC notice where the haircuts were like 100% for MBS collateral for their intra bank repo transactions. So I'm really curious on, since we can use, since the Eurodollar system is very opaque, right? Can we use different proxies to look at, tightening credit conditions, or what the landscape of credit intermediation is happening over in Japan? Since, I don't think this is validated, but in my opinion, I think 1 out of $3 credit in existence is levered in Japan. And I think for a reason, because, it's the largest carried. I don't know if the 1 out of $3 credit creation is true, but I reckon so much of the U.S. equity markets flows have been coming from Japanese denominated or assets swapped from Japanese denominated assets, since historically borrowing costs have been really, really low. So an example is SoftBank, right? Masasan's a balance sheet capacity, and as well as Nomura and all them. I don't know if you guys remember, in 2019 there was a Fed blackout. There's like a repo loans blackout, and Nomura received $4 trillion in repo loans in 2019, and it just had a media blackout. But I was kind of more thinking about how the dollar milkshake plays in with deflationary pressures on other currencies and economies, and the overall global dollar shortage we're in, like a massive one. And Jeff Snyder was actually he had a video a couple days ago, maybe. He was showing foreign amounts of U.S. Treasury. It was like U.S. Treasuries sitting on the Fed's balance sheet of foreign depository institutions, and I think we hit levels, below the 2023 banking crisis and below COVID. So we can see a lot of foreign institutions are having to sell U.S. Treasuries for dollars because there's such a big shortage. And we can also see that Mr. Vix, like Yield Searcher, he also likes to post a bunch of yen and euro cross-currency basis trade data, which really shows rising funding costs in the Eurodollar system. And I'm curious, what other rates can we use? Like, there's the Tokyo overnight rate. There's a few others in Japan. What can we use? What are some other proxies can we use at institutions like Japanese banks to kind of see what the landscape of Eurodollar funding is, because I like to think
Yeah,
about
I can. You've asked like 5 questions.
no, for sure. There's one more
Yeah, I
thing.
did.
So, everyone's aware of like what U.S. market makers do, right? Taking volumes and flows of retail orders, at wholesale venues. So, in the Eurodollar system, in September 2019, we had a repo crisis, right? Illiquid repo facilities, because not enough dealer banks were stepping up. So, say if you got Citadel, Point72, and Susquehanna, and one of these institutions are knocked out, there's a entity that steps in for that flow, right? To take on that credit intermediation volume in the Eurodollar system. So it did not happen in September 2019. No one stepped up to provide liquidity or provide or being able to use their balance sheet to essentially extend credit at large volumes. So are we seeing that now? And what are some backstops in the system? Because in April, if we look at the resale and repledging of Treasury tick international capital data, the top 5 prime, the basically all the shadow banks in the world, we can look that there was a large deterioration of collateral quality, because we were seeing, and Snyder also confirms this, that the top 5 prime banks were extending cash dollar loans, dollar credit to all these shadow banks with dog shit or junk collateral. So if we get another seismic event like April in the dollar funding markets offshore, I don't think the top 5 prime banks are going to extend credit to the shadow banks this time. Like, I don't think they're going to do it twice, because the shadow banks clearly have huge amounts of dog shit collateral, and I'm just not seeing any evidence for with the real resales metric on those
All right, Fidel.
data
I'm gonna
points.
let
done.
Robert answer this
Yeah,
question for
yeah.
you real quick, buddy.
I was just rambling. Appreciate you guys.
All right, yeah, Robert, take it, stab at it, whichever one you like. But I will throw my 2 cents in there, and I measure the overnight activity, and it's been blatantly obvious for almost 9 months now that they've been liquidating short-term treasuries overnight. We have buyers in the United States that have to absorb them because they need them for collateral. So that's one way they're laundering dollars back to Japan. But pick a question and have at it, sir.
Sure, absolutely. And actually, I would love to like talk to you more about that, because that's interesting. So Japan is really important, because Japan, for everyone in the audience who like doesn't really follow Japanese macro, they've essentially been the linchpin of the global bond market for the last 30 years, right? Ever since they had their real estate market and their stock market implosion in the 90s. They've gone to, first 0% rates in 99, and then they were the people who invented QE in March of 2001. And then they invented something called QQE, which is just QE with extra spiciness, targeted to specific durations of bonds or specific types of equity instruments like ETFs. And then they were also obviously the progenitors of yield curve control after Bernanke flew there in August 2016. And so, or excuse me, actually, it was July. So they've essentially had 0% rates for 30 plus years or so. And because of that, the Japanese retail investor and the Japanese banks have had a funding cost of literally zero, but also they've had a problem of zero growth, right? Their stock market, the Nikkei, basically went nowhere up until just a year or two ago, when it finally broke above the 1990 or 1989 high. And so in that like infinite liquidity, infinite money, zero funding costs, but no growth environment, the majority trade became a carry trade, became borrow in your own currency and lend to other sovereigns at higher rates, right? And it makes a lot of sense. If your funding cost is literally zero, even if the British gilts are at 1 or 2, or the German boons are at 2 or 3 or whatever, and the U.S. Treasury bonds are at 4, you'll buy as much as you can, because that's better than making zero. And if you have to invest in stocks, why would you invest in Japanese stocks? They haven't gone anywhere, and there's no fundamental growth story there, but there is still in the U.S., right? So because of those headwinds, especially the demographic headwinds in Japan, Japan is just stagnated, and their capital has become essentially like the global savings pool of the world and just flowed out into every sovereign bond market. And it's gotten to the point where, right, we're talking like trillions and trillions of dollars a year are flowing from Japan into the West, especially the U.S. capital markets, in the form of these trades. And because of this, this obviously functionally puts directional pressure on the currency. So I actually talked about this on a podcast just recently, right? If you look at USD JPY, just last Friday, so about a week ago, we had a huge sell-off in Bitcoin and SPY, right, after the Trump, tariff announcement, surprise 100% tariffs on China. And USD JPY unwinds 1%, within the course of the trading day. And the majority of the move comes towards, the beginning of their trading session, which is, basically like our morning, but their evening. And so as soon as that hits, 15 minutes later, you see downward pressure starts to form in SPY, and then Bitcoin gets slammed. So the USD JPY is one like really good measure of liquidity that I use for the carry trade, because whenever it moves in size like that, that someone's getting unwound, right? If you see USD JPY go from 153 to 151 in the space of 2 days, usually that's a carry trade unwind. And so that is like a very key thing to watch. But as you know, like, because of the fundamental problems with Japanese economy, because of the 260% debt to GDP, and the 130% private debt to GDP, and the 20% of companies on the Nikkei that are zombie companies, essentially. Morgan Stanley found that they were only surviving by rolling over short-term debt at 0%, and there's no other way that those companies can survive. Because of those factors, Japan is kind of trapped. They can't really raise rates materially. They're already at 0.5%. They can't normalize with the US, and they can't really stop stimulating fiscally, because they're already facing, kind of, you could say, like, macro headwinds in terms of their, growth story. So they can't really stop the stimulus in any way there. And if they don't do anything, which is what they're kind of doing now, they stop the interventions, then the currency just slowly blows out, and all of your imports become more expensive, and inflation goes higher. So it's kind of a slow death either way. It's just a death of, do you want to die via inflation and credit freezing, or do you want to die, or sorry, deflation and credit freezing, or do you want to die via inflation and energy price shocks? And so they're choosing the latter. But it's right, every sovereign will generally choose the inflationary route. As for your question about like the actual things to watch, I would agree with what real John Galt said. Really look at the Japanese repo market. Just Dario actually was on my Substack podcast just a few weeks ago, and he was documenting how in the space of August, almost every single day, the Bank of Japan was doing basically like emergency repo transactions to the tunes of tens of billions of dollars to inject capital into the markets. And of course, they changed the regulations so that no longer you can see the actual banks that are taking the money at the repo window. But the theory is that it's several of the large Japanese banks. So just Dario is saying, Norinchikan, which is the one he's been pounding the table on being underwater on their JGB portfolio, but many others, right? Like the entire Japanese commercial banking industry swallowed JGBs wholesale for 30 years. And then the Bank of Japan has let yields on the long end rise to 3.3% for the 30-year. So if you're a bag holder at 0, you're definitely a huge bag holder at 3.3%. And so a lot of Japanese banks could be facing trouble, and that's why they're doing these repo market injections, which also explains why USD JPY is blowing out again in the last few weeks. But John, what did you want to say?
I just want to throw this in real quick. Mr. Dario, just Dario, is going to be on next week. He's joining us. That's one of the subjects we'll be discussing. The Japanese life insurers have been participating in this also. It's not just the banks. So their creep has gone beyond the point of just the banking system, similar to what happened in America in 2008.
Yeah, absolutely. And again, you can also see this as a you could call it like a variant of the 2023 commercial banking crisis, right? That one was not only obviously a crisis of actual assets because all these banks had bought, especially Silicon Valley Bank had bought a bunch of treasury bonds at 0% before the Fed started hiking, but also like a duration mismatch, right? You have a lot of liabilities that are short term, like depositor outflows, and then you have a lot of assets that are long term, like 30-year bonds. And so, how do you balance that on your balance sheet when you can't get out of those long bonds without taking huge mark to market losses? It's kind of a trap, right? And so Japan is just facing that in larger scale than the US because they're at 260% debt to GDP on the federal side and 130% private. So again, you can't really like the Bitcoiners like to say, you can't really taper a Ponzi. You can't really back your way out of this credit bonanza without causing some serious harm or without doing some major QE. So the road ahead for the Bank of Japan is difficult, but I think all roads lead to more easing.
Oh, 110%. And I think that they've trapped themselves in a cycle of perpetual easing, so to speak, or perpetual quantitative easing, where they have no choice. But as they do so, they're finally starting to see deterioration in their bond market, where it is becoming a bit of a crisis. Either they have to give up on the currency itself, which is very negative for the American market and the carry trade, or they have to sit there and buy their own bonds up and keep it under the current levels. You have a breakout in the 30 and 20-year JGB. That's going to wreak havoc on their financial system and ours. And a lot of people don't realize that's part of the carry trade.
Oh, absolutely. And again, like for the people who think, oh, well, hey, PB, you were saying that the USD JPY was going to blow out unless the bonds blow out. Well, look, the bonds are blowing out, so you're wrong. Well, how sustainable is that, guys? Like the bonds at 3%, like let's take the weighted average maturity of the debt and move it to 3%. Let's say everything gets refinanced eventually at that 3% level. They would be paying like 8% of their GDP in interest expense alone. 8%. So comparatively, that'd be the size of the entire U.S. deficit of 7% of GDP for them, right? So imagine the equivalent of $2 trillion a year in the U.S. being spent on just interest. So that's double what we're currently paying. So clearly, it's unsustainable. And the idea that they could normalize with the Fed is also laughable because even with the recent Fed cut in September, it would still be 9-10% of GDP. And again, the math is very simple. It's if they're at 260% debt to GDP, then a 1% rise in interest expense, across the entire maturity curve, for all their debt means a 2.6% increase in interest expense as a percent of GDP. So they're paying 2.6% of GDP as interest expense for every 1% rise in the nominal rate. And that's completely unsustainable, right? I think I did a piece back in June called "Flipping the Yen," and I made a thread about it too that went a little viral. And I think I had found that like for every 110 basis points increase in the average weighted maturity of the debt for Japan, they're paying for an entire U.S. Navy fleet, like the entire U.S. Navy, like all of our ships, all of our ports, all of the sailors, they're paying for basically funding that entire thing every time the yield goes up by that much. So that's why watching those 30 and 40-year bonds is important, because if they allow the debt to be refinanced at those levels, it's going to be catastrophic for them. So I just don't think they can. I think they're letting it do that temporarily to take off pressure from the currency, but in the long run, like like I said, all roads lead to more devaluation and more suppression of real yields.
We'll take a quick commercial break. First of all, macroedge.net/ozone, macroedge.net/ozone. Get your 2-week free trial. Check out our new institutional paper platform. You can subscribe to that if you're an institution. And we also have real estate. And we also have a fantastic dashboard that's being built. Go to macroedge.net. Check out the future. We're trying to present facts, an alternative path to a lot of the things that we're hearing and seeing from the government and other sources who have an agenda to push. We're trying to report macro the way it's meant to be, black and white, bottom line information. Also, our great guest tonight, Robert Rios, the Peruvian Bull. Do not miss $endgame.substack.com. His latest piece ties directly into the conversation he was just having about the Japanese. The gold rush, gold bugs, your time has finally arrived. I will simply say he's got it available for free right now if you want to go check it out and subscribe to his Substack. One of the things that stands out from all this, Robert, is that I think the Japanese central bank made a mistake. I think the Bank of Japan had an opportunity to raise rates, buffer the deterioration on the yen, and give themselves more runway to play with. And now it's going to play wide and variable because they're more subject to the whims of Besant, our trade war, and everything else that's going on. If you really think about this, they're basically making their policy subservient to Fed policy, which is subservient to the United States government policy, which no one really knows what the hell it is right now.
Yeah, that's a really good point. And again, this is, I guess one of the implications of dollar milkshake theory that's posited by Brent Johnson, right? Like, okay, if the U.S. issues the world reserve currency and the rest of the world, because of the structure of the global monetary system and because of the euro dollar system and the petrodollar system, the rest of the world uses those dollars and then also borrows in dollars and collateralizes their assets in dollars and reinvests all of their proceeds and excess profits into dollars because they're the most liquid, deep, high growth market in the world. Then that means by extension, everyone obviously has huge exposure to dollars. And so their central banks have to keep an eye on the exchange rate. And in monetary economics, there's something called the policy trilemma, right? And so people who maybe I'll try to find a tweet about it because I have the actual, like triangle up somewhere in my tweets. But the policy trilemma says that you can basically have two of the three corners of a triangle, and the three corners are free capital mobility, a fixed exchange rate, and monetary autonomy. And so, if you're going to allow, a free capital mobility and monetary autonomy, meaning you do what you want, you're giving up a fixed exchange rate, right? So you can only have two of the three. And the problem is, every single country essentially wants to keep their exchange rate within a certain bound, right? Nobody wants their exchange rate to blow out either way too weak or way too strong. And they also don't want to close their capital account and they want to allow free trade. So, like, Japan's a great example. Japan is a net exporter. They want to allow foreign investment into Japan. They want to allow foreign capital to flow in, whatever, little that does flow in because of their low growth. And so to do so, and to keep the yen at a reasonable level and not from blowing out at double the GDP or debt to GDP that we have as a percent of the economy, they have to give up their monetary autonomy. They have to say, okay, when the Fed hikes, we hike. When the Fed cuts, we cut. And the ECB and the Bank of Canada and to a certain extent the PBOC all kind of have to follow suit, right? Because where the Fed goes, the dollar goes, and the rest of the world must follow. Because again, everybody has exposure to dollars, either directly or indirectly. And if you're a central banker and you don't think you have exposure to dollars, just wait until you have a dollar shortage crisis and all of your regional gold producers or iron producers or oil producers start screaming at you for dollar swap lines in order to conduct business, because it does happen, and it has happened many times before in history. So because of this, the world has this globally synchronized central bank cycle, right? Which is why everyone watches what the Fed does, even if they're not American and even if they're not directly invested in US markets. And so, again, as a result, whenever the Fed moves, this creates massive moves in basically every single currency. You can see this in 2022. One of my, I guess you could say, the seminal pieces, if you go to my Substack and look at like the top pieces, there's one called, I think it's called Battling a Godzilla, another one called Tokyo Drifting into a Currency Crisis from just like a year ago. And in both of those, I lay out how you look at USD/JPY, and it sits at 110 in January of 2022. The Fed starts hiking in March of 2022, right? From March to September, USD/JPY blows out from 110 to like 155. And the Japanese start doing their largest currency market interventions in 23 years that year, since the largest since 1998, in order to save their currency. And the pound and the euro all fall to 20-year, 25-year lows against the dollar as well, because the Fed started hiking long before the other central banks had decided to catch up. And of course, that gap has now narrowed, especially with the British pound and the euro. Ever since the euro, the ECB and the BOE both started to normalize with the Fed, but the Bank of Japan was kind of trapped. They couldn't really do that, right? Like we said in a previous section, for reasons that I've already laid out, you can't really normalize with the Fed when you're at 260% debt to GDP. So that's why they've continually tested that red line and not really been able to back off the 150 handle in any meaningful way. But again, that means that where the Fed goes, the world follows. And so if the Fed's easing, you have to ease. If the Fed's cutting, you have to cut. And if the Fed's hiking, you have to hike. And so now with the Fed starting an easing cycle, it means that the implication is not only is the Fed going to be easing in the next, let's say 3-4 years of the macro cycle, every other central bank is likely going to follow suit as well. And so that's even more of tailwinds for gold, because that will implicate more and more liquidity being funneled into the system and more bidding going for, hard assets in a world of infinite liquidity.
And a highlight of this, and this is the monetary debasement theory you're talking about. Just Japan is about 5 years ahead of America. Boys and girls, I know a lot of you don't follow gold in other currencies. In 2010, the Japanese yen was trading at about 100,000 yen per ounce. We're just north of 628,000 today. It was actually 638,000, I think. Let me go check my update. 638,000 today. That is a dramatic statement as to the deterioration of the quality of the yen as a viable currency, and why it can never be a reserve currency. It'll always be a trading currency, like many third world countries are, emerging markets trade. That should be a warning sign for everyone as you hit the demographic wall. And America, we're teetering on that demographic wall, and we're about to smash into it pretty hard. With moving on from that, do you think we're going to see more monetary debasement in the euro? Or because the Swissy is indicating they're not going to allow it. So with negative yields in Switzerland reemerging, with Japan completely dependent on the Fed now, it would appear those nations that are hoarding gold to avoid being sanctioned out of existence by the United States if they disagree with their policies. We have a major split occurring in the world between the older established current economies and blocks versus the younger emerging markets. And China is still a young market compared to Europe by any stretch of the imagination as far as capitalist development. We're seeing a conflict where the newer block is adopting gold as a hedge, and the older economies are saying, well, it's just a useless yellow metal. Your opinion on that?
Yeah, I mean, clearly, like this is kind of like where the battle lines are being drawn in the global monetary system, right? And Zoltan Pozsar famously wrote about, basically this exact thing happening with Bretton Woods 3. But essentially, right, like the global central banks are now looking at a world where U.S. Treasuries are falling in terms of real value, right? Because if you buy in 2020 and the Fed hikes rates to 5%, the TLT goes down 50%. So you're on the long end, you're at the 30-year or the 20-year, you've taken a huge beating on your portfolio. Whereas if you're only in 1 month or 3-month or 6-month Treasuries, it's not as bad, right? Because of the convexity. And so because of that, they're looking at this world where, okay, the Fed is essentially going to have to lower rates again. Inflation's basically going to run hot, and they've admitted that, right? Inflation is still above target, and they've even there's been several comments from Fed governors saying, like, yeah, we understand that inflation is probably never going to get back to the 2% target. We may just get rid of that target altogether, or we might move it higher. And the U.S. government itself is in $37 trillion of debt with $1.1 trillion of interest expense every single year, right? So huge debt spiral problem. And so there's going to be no shortage of treasury bill issuance and treasury bond issuance. And there's also going to be no shortage of inflation in the US. And so when you look at that setup, you say, okay, well, I can continue to buy US treasuries, especially on the long end, or I can kind of divest myself slowly, kind of walk out of the proverbial Homer Simpson in the bush, right? Where he like kind of slowly backs into the bush without anyone looking. I can kind of pull this kind of secret sleight of hand where I allow my long bond treasuries to run off, and I reinvest the proceeds into gold. And that's largely what's been happening, right? You look at foreign ownership of U.S. treasuries as a percent of total, it's been falling, really since 2015, but even before that. And you look at as a percent, like net new debt from 2008 to 2015, $8 trillion of new debt was generated in those years, and foreigners bought around 71% of it, mainly China and Japan. And from 2015 to 2021, when I ran the numbers again, they were only buying 14% of net new debt. So they collapsed from being the majority buyer to a small minority buyer. And if that trend continues, obviously they'll be basically zero, on net zero. I'm not saying they're going to go out tomorrow and sell all their treasury bonds. Not saying that, especially the bills. They have good reasons to keep those for dollar liquidity. But the reasons to buy a long end treasury bond are starting to become scarcer and scarcer. And so the diversification into gold, into something like, gold or silver or hard money that stores value over time and doesn't be, isn't degraded with inflation, can't be seized if you hold it in your own vault. A cyber attack can't take it away, right? Barring basically an invasion, you're not going to lose it. Makes a lot of sense. So I think that central banks, they're not necessarily responsible for the day-to-day fluctuations in the gold price, but in my opinion, they're just putting a steady floor, a steady bid underneath the gold price every single month, just by slowly buying more and more and draining all the physical supplies from both producers and even exchanges.
I agree. And I think what we're seeing now with the diversification of exchanges and some of the questionable activities of the LBMA and the COMEX, I'm not saying that they're committing anything that's suspect. I'm just saying questionable. I'll be nice. Don't want to get sued. You're seeing development of markets in Shanghai, Hong Kong, Dubai as alternatives to the traditional financial money centers of the West. That is not a measurable degree of impact yet, but it is going to become one as emerging economies say, okay, I want to put my gold here versus trusting the people who might seize it because they don't like my political policies or stances on a particular issue.
I mean, I think actually, I do think it's a driving factor. I've wrote a piece, actually a couple pieces, if you go back on my Substack in January, February, and March of this year on the Shanghai Gold Exchange, and I was directed to this by VBL. If you know who that is, he writes the Gold Fix
Oh, yeah.
Substack. Really great,
You got to follow
really
him,
great
guys.
metals guy.
Yeah, trust
Oh yeah,
Robert. You've got to follow him, Robert. Robert's correct. I'm sorry to
yeah,
interrupt. You've got to follow
yeah.
VBL.
He's great. He's great. But the Shanghai Gold Exchange, they started an international division in 2014, and the unique selling point of Shanghai is that it's physically settled. So the Western markets, right, for years have been basically mainly cash settled. COMEX and LBMA, something like 97% of futures trades that go through those exchanges are settled in cash, which makes sense if you're, a hedge fund or a high net worth investor. You don't necessarily want to take delivery of $50 million worth of physical gold and have to do all these, do all this paperwork, pay all these fees, pay Brinks, get a security truck, and then figure out which vault is going to store it for you and pay like 2 to 3% per annum of the value of your gold holdings forever just to store it and keep it safeguarded. So rolling it over in terms of paper, just for cash, made a lot of sense. The problem is obviously this created the incentive for bullion banks, for brokers, for exchanges to just naked short gold contracts. And ever since I've been, in macro for the last 10, 12 years, we've seen, gold bugs the world over claim, hey, this is unfair. Gold, the physical or paper gold to, physical is what, like 100 to 1. It's 80 to 1. This is unfair. They're going to break. I'm going to buy gold today and it's going to break the COMEX. I'm going to keep buying my futures. It's definitely going to break this day, guys. And it never works. And the reason is because none of them actually took delivery, and there wasn't enough of them taking delivery to actually make a dent in anything. But now you have an exchange in the East, right, in Shanghai, that's physically settled. And starting in 2023, in I think it was June and July, but especially accelerating in February and March of 2024, we started seeing a delta, right, a price gap, just like what is happening now between the COMEX and LBMA. We saw that open up between Shanghai and COMEX, and that represented, like, on average, a $55 price differential for gold, and several dollars for silver. And so all these traders started saying, hey, like, I could buy a bunch of gold in the West for $50 an ounce less, and I can ship it because I can actually, if I buy in size with my bank, behind me, I can actually buy enough to warrant the transportation and logistics and security costs. And I can ship it over here and I can sell it for 50 bucks, $70 more an ounce. And if you multiply that by enough ounces, you basically are generating free money. And so this massive drain started happening on the COMEX, which obviously we saw a huge inventory buildup because they started seeing their net new contracts explode, especially again in January and February of this year. And again, that same process is now running to the LBMA. And the LBMA had already faced stressors from early this year when this same process of draining from the COMEX had also affected the LBMA, and the LBMA was forced to start borrowing from the Bank of England. And we famously saw those headlines saying, look, the traders and banks are waiting 6 to 8 to 10 weeks for deliveries on gold. Does the Bank of England even have the gold that they claim to have had and that they've sold paper IOUs on? And they're eventually, with enough time, I think any institutional player is allowed to give themselves enough time to solve the problem, at least temporarily. But as the story continues, as you see the physical demand story coming in from China, the West is going to be forced to catch up, and the West is finally being forced to allow the paper markets to meet physical reality. And physical reality is frankly much, much higher. And this play on China, by the way, is I actually had talked to VBL today, and the thing is, China isn't just doing this on the exchange side. They're not just saying, "Okay, I see your paper market, I raise you a physical one." Basically screw the screw the West. They're also doing this on the retail side. So starting just a few years ago, China started encouraging their citizens to buy gold wholesale, and they started allowing banks to lend against gold deposits in their vaults. Now you can buy gold, but you can't transfer it out of China. So like to stay true to their capital account and I guess you could call it like restrictive capital measures and kind of Orwellian economy, you can't really check out of this Hotel California, but you can take collateral on it. And so if you're a Chinese, or you can take a loan against it on this gold collateral. So if you're a Chinese investor and you're buying gold, now suddenly you have a source of collateral that you can borrow against to fund whatever you want. And oftentimes, right, the loan rate that they'll give to a gold backing in their own vault will be lower than any sort of equity loan or bond loan or loan on Chinese real estate, which is its own dumpster fire right now. So that's causing a huge demand rush in China. Demand for not only jewelry, but especially bars and coins is exploding. And that's just causing, of course, again, like this retail institutional demand or retail, groundswell investor demand to explode, which just means more and more pressure on the exchanges to get as much physical as they can.
And that brings us to the anecdotal evidence we witnessed this morning. And I don't know, boys and girls, how many of you follow this on X? I'm one of those weird people that get up early in the morning and sometimes stay up until the wee hours. Probably how I got my cold. You saw the videos from Vietnam and Australia of people lining up to purchase gold. And that right there is an indication of how far behind America is in the curve, because we haven't seen that retail fever yet to the degree that we have overseas. It's small, it's present. You can still obtain gold. It hasn't become unobtainium, as we like to joke in the gold bug community. But there is evidence that the wealthy, and we've all talked about this or have dealt with this at some point in our lives, they don't take delivery like the average citizen going to a coin store. They get a delivery from a Brinks truck, as you said earlier. We have to sit there and take into account, we don't know what the ultra wealthy are doing in our country. But if you're seeing the average citizens overseas starting to accumulate and panic buy like that, it's only a matter of time before Americans start buying at the top, as we like to say. Wouldn't you agree?
I mean, absolutely. But the question is, like, where's the actual top, right? There may be temporary tops, sure, but I think again, if you just look at the stats, right, 2 to 3% gold portfolio in the portfolio allocation in the U.S. and historically it's 10%. With the macro factors of the deficits and inflation, it's hard to see that gold won't rise further in the next 3 to 5 years. That this is like the all-time top. So we are again reaching a little bit of mania here, a little bit of gold fever, you could say, because seeing the general root, like line on Wall Street is, if the shoeshine boy knows about it, you're too late. So if people are lining up at Costco and, in Sydney, Australia, and I've seen, obviously Shanghai and Hong Kong and Singapore, like if people are lining up there and they're just average retail investors, yes, there's probably reaching the phase where, people who are investing in this space and they don't really know why they're investing, they're just chasing the trend. But that also doesn't mean that the trend will necessarily stop like anytime soon, or that we're gonna go back to $2,000 gold or 1,500 an ounce gold, and stay there forever. Like I think this is just a symptom of crowd behavior of mass psychology. So again, like we might be overbought in the short term, the 1 month RSI or the 3 month RSI, but long term, I think we're gonna go higher.
Agreed. And I don't want to keep you too long, so let me get to the last of the questions here, because I will say this in defense of Costco. Their premiums killed my dealer. I'll buy from Costco anytime. It's like, holy cows, these are great premiums compared to what you can get online and from my local dealers. And they admit it, they acknowledge that. So it's sort of cool being able to obtain silver and gold at a decent price. And I imagine we're going to start seeing platinum and palladium at Costco soon too. Um, I said we're going to talk miners. We can all talk about the major miners all day long, but that's sort of boring because they're going to plod along until they can find more juniors to swallow. Full disclosure, I'm out of all my juniors. Got out yesterday. Somehow I timed it right for once in my life. Is this not the time to start analyzing potential takeovers targets? Because it seems that there's not enough mining capacity to meet the demand, not just for rare earth metals, but for copper, silver, gold, platinum, palladium, etc., uh, in North America. And because of the trade policies, those miners that have actual functioning exploration, etc., possible discoveries or future developments, they're going to become quite interesting, aren't they?
Oh yeah, for sure. I mean, again, like I said at the outset, right? Like you have to understand, everyone listening to this call, please take my experience as advice. Like investing in the miners is a different ball game than just investing in the physical metal. And you can buy a miner where everything looks good and you think, oh, they have a permit in Peru and they're going to be pulling out like, 800,000 ounces and they're going to be of gold and they're going to be making so much money and they have, their all in costs are under $1,000 an ounce and this is going to go so well. And then the wrong regulatory approval can come through, right? Or regulatory disapproval. You can have environmental concerns. You can have, weather problems, energy problems, obviously, if oil prices rise and squeeze their margins. Like all these external factors can happen to destroy the miners. But yeah, I mean, I think especially like I would look at obviously the microcap juniors, the ones that are like single mine plays. Those are, if they're not producing, those would be targets for sure. I haven't kept up recently on all-in costs for the major miners. I've stopped following the major miners ever since around 2021 because I just switched to just buying physical gold and not worrying about the miners. Um, but I mean, from what I remember, like the big boys like Newmont were around, 1,200 an ounce. And so I just looked it up here, it's 1,600 an ounce all in costs for gold. So if the major miners are able to get their all in costs sufficiently low, and if the gold price keeps rising, you don't even need to look for a takeover play. You can just look for almost like a dividend play, right? Like if they're able to get steady monthly income, positive cash flow from their operations, that's what you want. And so just look for miners that are achieving that, and that aren't these like huge speculative plays on they only have a single mine and their mine is in Chile or Peru or South Africa and it's waiting on 15 different regulatory approvals and there's like a coin flip whether the CEO is like a coke addict or actually smart and knows what he's doing. Like don't go for those miners. I've been burned enough on those. Just go for the big ones is what I would say.
Yeah, know who is running the company, I think, is the number one uh, most important thing to understand. And also pay attention to what they're saying to their shareholders. Are they just issuing shares to sit there and buffer and build bonuses for the CEO and the officers, or are they actually using it for physical exploration and obtaining land and capital improvements? I don't want to abuse our time. You have been a great guest, Robert. I just want to get to this one question because everyone wants to know. We didn't talk about silver much, and that's fine because it's going to catch up. But I do want to sit there and focus. You and I both are of the same mindset. I think gold is way due for a pullback, and my figure is around 10%. Not just the RSI, but also because just a chart exhaustion feature. I'm not a big technician as far as that goes, but when you look at the charts, it's begging for 10% pullback. And that, of course, brings the gold bears back out, which I think is hilarious considering the condition of the economy right now. What do you see in the future, without putting a number on it, unless you want to, as a potential support area? I'm saying 36 to 3,800 is your new level of support, with a potential for over 5 next year based on what's happening. Please go ahead.
Yeah, for gold, I would agree with that as the strongest level of support. I'd also say that 4,000 is a psychological support level, right? Like a lot of people thought that we weren't going to be able to break 4,000 this year. If you remember earlier in this year, JP Morgan had raised their target from like 3,600 or 3,675 to 4,000, but they said that we weren't going to breach 4,000 until literally like the end of the year. They forecasted December, and we already broke through that level, decidedly. So I'd say that 4,000 is another level of support. Then obviously, like you said, 3,800 and 3,600 below that. But I don't see a world in which we're going back to sub $3,500 gold. I think, even with a pullback, because we're in a slightly overbought level, again, the macro factors are just too strong. For silver, I wrote a piece back in September called Silver Slumber, which was essentially, at the time, silver was still kind of range bound, right, while gold was rallying hard. And I was trying to figure out, like, why is silver, so kind of comatose when the rest of the precious metals are ripping. And the way I phrased it in that piece is, gold is a monetary metal with industrial applications, and silver is an industrial metal with monetary applications. And that's very important to understanding how these two markets operate. Because for people who are just like a pure silver bug and gold bug and think that they're both interchangeable, they're not, right? Silver has far more industrial applications and industrial demand than gold does. From a report I read from I think it was CME Group, they said that 59% of total demand for silver is industrial demand. And then on top of that, there's another like 20% that's coming from, other sources, governments, high tech research labs, all that kind of things. And then it's only like the last like 20-25% that's industrial, or what do you call it, investment demand. So that's like speculative, like buying silver for storing it at home, or for, trying to figure out what's going to happen with the silver price and then sell at the highs and then buy more at the lows, like whatever you're doing. So the silver ratio that we've had historically, like in the last couple thousand years, of like one ounce of or 10 ounces of silver for 1 ounce of gold, or 7 ounces of silver for 1 ounce of gold, I don't think we'll ever get back to that. So, unfortunately for the silver bulls that think that we're going to go to that level of a of a ratio, I think that that's probably improbable. But I do agree that the gold silver ratio here is very stretched, and you could definitely see a compression back to the 50 handle or back to the 40 handle, just based on solar demand, um, based on industrial demand, based on EV, right? If Elon is going to keep building out all of his not only his solar plants that he wants to build, obviously, and the battery production in the U.S., but also actually building out Teslas and electrifying the entire grid, like nationwide. That requires like thousands of tons of silver, right? Or even maybe tens of thousands. Like, it's a lot of silver we're going to talk about, and that stuff will have to be mined, refined, shipped, cut, corded into electronic equipment, and then used in electronics. So overall, I think there's a lot higher to go in both markets. But yeah, I'm just, I love to be a silver bull, and I am, but like I'm not seeing that we're going to get back to 1 to 7 for the gold silver ratio. I think that's just improbable.
And I totally agree with you, sir. I think 30 to 40 to 1 would be the absolute peak. And at that point in time, by the way, boys and girls, the world will be on fire if gold is $5,000 an ounce. Robert, please highlight again your Substack at Peruvian_Bull on X. You have been a fantastic guest. Do not be a stranger. We would like to have you back on again, maybe around your end if you're available, or the first of next year, so we can talk about 2026. Because I have the funny feeling we're about to see a dramatic period of instability, which is not bearish for precious metals bulls by any stretch of the imagination. Advertise your Substack, and we'll close the show out tonight.
Sure, absolutely. I put the link in the nest. Also put up a couple tweets by some people I know, like Luke Roman, who've put out some really good work on metals. But yeah, I have my Substack there, $endgame.substack.com. Obviously, you can follow me here on Twitter. Also have the YouTube, and I have obviously podcast appearances. If you just search Peruvian Bull on YouTube, you should see a bunch of my stuff. And I have a podcast with VBL that's coming out shortly in the next few days. I just have to edit it. We filmed it this morning, so should be coming out hopefully either tomorrow morning or Sunday morning.
Fantastic. The Peruvian Bull, Robert Rios, thank you so much for joining us on MacroEdge Radio. MacroEdge.net/ozone. Get your 2-week free trial. MacroEdge.net/ozone. Check out the new institutional board and all of the available products. We are expanding rapidly. Yours truly is a loyal writer there. Ignore my snark. I'm more of a historian. I view things from a historian point of view. And that's why you see some of the commentary that I have. A lot of what we're witnessing now, we saw before, right after 1971, except the instability this time has a larger degree of uncertainty because we didn't owe this much money to ourselves in the world. For MacroEdge Radio, next week,